I don't know when it was. Maybe you remember this, but the FDIC, who's supposed to protect depositors' accounts, the public's account, they're now would be on the hook for protecting the banks from losses from derivatives. So I think it's a can of worms. And do you remember 2 or 3 weeks ago that Jamie Dimon had a private conference in Washington, D.C.? He invited Scott Bessent private meeting between Wall Street and the government because I think it was a time of this crisis where, and they told Bessent, if you guys don't back down with these tariffs or whatever, the whole Treasury market is going to collapse. I think that's what was happening. This was like, and that's why they backed down. Friday, May 2nd, 2025, Maneco 64, home of alternative economics and contrarian views. Well, I got a comment on the live stream, Clive, on Sunday. Has Clive abandoned your channel? He's got his own channel now. No, Clive just went away on holiday and he's back now. But his channel is doing well as well. You should check it out on YouTube, Clive Thompson, and subscribe to it. So, Clive, welcome back. Yeah.
Well, thank you very much, Mario. The channel I'm on is not really exactly the same topic as ours. Of course, we'll be including gold and silver and so forth as your channel, but I'm trying to do more of a walkabout in the countryside and things like that, and talking about investments generally. But there will be a strong focus on those who want to learn how to make money on the stock market, which is something I've been doing for 50 odd years. And I hope people will learn from my mistakes and not make as many mistakes as I've made over the decades, and hopefully learn some of the tips I've learned about how to make it work.
Well, I will certainly be looking at it, Clive, because I want to learn more about the stock market. I've been more of a bond and gold guy, maybe the miners, but it's nice to. I think you're right about sometimes you have to diversify. But the topic we're going to cover today, mainly, and then we're going to look at other things, is how, in my opinion, the Treasury market, U.S. Treasury market, safe haven status is hanging by a thread. Uh, and it's thanks to derivatives casino, and we're going to look at that. But Clive, before we go further onto the topic, I want to thank the viewers who sent me goldbacks. So two of the viewers sent me goldbacks. So one sent me 1/1000th of a goldback, and the other one sent 1/2000th of a goldback. So I'd like to thank both of the viewers for sending that. And to be honest, you don't have to send me anything, but a lot of you have sent me stuff in the past. And if you want to send me stuff, I'm not saying you should, you need to send it to Gold Investments. And yes, the details to Gold Investments are below in the description because I don't have a post office box and I don't want to give out my address. And then, Clive, there's something that I also got from another viewer, and I'm not going to use their names. They might not want their names publicized online. But it's this. I have a few of these. So this is from the U.S., the Philadelphia Mint, from 1964. So it's still in perfect condition. So what have we got here? Well, we've got a $50, a quarter.
Is that what's called a Kennedy quarter?
No, it's a George Washington.
Okay.
Kennedy is on the $50. Washington is on the quarter.
Hmm.
And then you have a dime. It's FDR. And these are all 90% silver, the $50, the quarter, and the dime. The nickel, of course, is not silver. Nickel is over here. That's Thomas Jefferson. And the 1 cent coin with Lincoln, that's copper.
Well,
And
that's going up in value, isn't it? Because copper's rising.
yeah, but that's only not that. But it has the original envelope from 1964. So I was only a baby, or I wasn't even born when this came out. And they have a nice little message about how to take care of the coins and stuff. So I thought I'd like to thank the viewer who sent that as well. So Clive, you sent me, and we'll share this first, and then we'll go because it is related to the Treasury market because it's about the U.S. debt. So I'm going to bring this up here. You wrote something. Maybe you want to talk about it on LinkedIn the other day. Uh,
Yeah.
yeah.
Um, so I think the question was what is going to be the effect of these tariffs on the budget deficit for next year, 2026? I mean, we're only going to have a partial effect this year. Now, first of all, the the tariffs will bring in extra revenue to the United States. And the question is how much and how will that affect the deficit? Now, the deficit for 2026, according to the Congressional Budget Office, that's the official party or department which estimates what the debt level of debt will be and what the deficit will be. The deficit is when the government spends more money than it collects in taxes. So at present, and this is based on January's 2025 forecast, their forecast, that's the last forecast they made, they say that in 2026, there will be a deficit of 1,865 billion or 1.86 trillion. That, by the way, is a very large deficit. It's the biggest ever, I think. Maybe the COVID year was slightly higher, I don't know. But it's certainly up from the 2025 forecast. 2025 is not finished, it finishes in September. So 2026 will finish in September 26. And they were forecasting in January 1.865. Now, Commerce Secretary Howard Lutnick has said maybe these tariffs will bring in 700 billion, which would certainly, if that was true, certainly reduce their deficit for that year. But basically, every commentator on the planet has said that's rubbish. There's no way it's going to bring in that much. And the party I turn to try and get the most accurate forecast is something called the Tax Foundation Center for Federal Tax Policy, which has been around for 80, 90 years in the USA. They basically calculate and forecast the impact of taxes, and also they advise on what taxes should be, although the government takes no notice of that, really. But according to them, the tariffs will reduce, or rather increase tax revenues by 190.5 billion, which is a drop in the ocean compared with the deficit, provided or assuming that the 90-day pause that we're now in, which is now a 60-day pause, I think, left, assuming that 90-day pause ends as scheduled. So when this period of the pause on the tariffs ends, these very, very high tariffs will kick in instead of the 10% universal tariff that they've got at the moment. So if they raise those tariffs in 2 months, then 190 million will come in. But they said the problem with that is that it will have a negative effect on the US economy. So taking into account the negative effect on the US economy, it'll only be 140.8 billion. And that assumes at this point that there'll be no existing or retaliatory tariffs from Canada, Mexico, and EU, which we know are coming. So they say that figure will be reduced further. So obviously the impact of the tariffs is not going to have much of an impact on the government's deficit. It'll have a very slight impact. It'll increase their revenue slightly. But what's going to have a much bigger negative effect on the forecast by the Congressional Budget Office, the CBO in their forecast of 1.8 trillion deficit is assuming that the Tax Cuts and Jobs Act, which was put in place by Trump a few years ago, will expire on the 31st of December. It's set to expire, but Trump has said he wants to make it permanent. Now, according to this tax foundation's estimate, if it's made permanent, the 2026 deficit will be $500 billion worse than currently forecast. So, taking the two together, we're talking about the deficit being 360 billion at best. Worse than forecast. It could be a lot worse than that, which takes the deficit for 2026 above $2 trillion, which is a absolutely massive figure. And to put that in perspective, it takes the deficit to 6.5% of GDP. Let's just put that in perspective. 2025 deficits are going to be 6.2% of GDP, according to the
Yeah.
Congressional Budget Office.
Yeah, and these 6.5%, 6% of GDP, this is crazy because usually you have that kind of deficit when you have a recession or a crisis. Can you imagine if and it's very possible we could get into a recession, Clive, because we saw GDP, the last GDP numbers came out on Wednesday. They were negative year on year. It was a big surprise. Um,
So
and
yeah, but the CBO is obliged to, when it does its forecast, it's obliged to assume that there'll be no recessions, no wars, no pandemics, no crises, and nothing else, which is going to cause the
Yeah.
numbers to be worse than the
So
forecast.
this is a best case scenario. And Clive, the reason I wanted to touch upon that before going to the Treasury market is because if that deficit gets worse, that means the Treasury is going to have to borrow more and more money to keep the Ponzi scheme going because that's what it is. Not just in the US, but in the UK as well. But we're going to focus on the US because the Treasury market is supposed to set the tone for all assets on the planet. It's supposed to be the safe haven, risk-free asset. But I was reading this article here, and I know it's in the FT, and I've been critical of the FT, but sometimes you need to keep your enemies closer, Clive. And I read this yesterday. I'm not going to read the whole thing because it's very long, but I've taken some quotes that I thought were interesting, and then I want your opinion on it. But it says, how the Treasury market got hooked on hedge fund leverage. Recent turbulence was partly the result of trading strategies using derivatives, but the same investors are increasingly important buyers of US government debt. So the reason why I feel qualified to talk about this, and I think people like Trump, maybe not Besant, but the whole 99% of the people out there, or even more, Clive, have no idea how leveraged these derivatives and hedge funds are, and that the whole US government debt structure now depends on these derivatives and the hedge funds. And I think it's really serious. I think Howard Lutnick knows the seriousness of it because that's the business he's been involved in. And actually, his late brother, and I remember this because I worked for just over a year at Cantor Fitzgerald when I came to London. His brother was known to trade the basis. So between the basis between the treasury futures and the cash treasuries. So I'm sure Howard Lutnick is aware of what's going on. But what I wanted to bring up here, Clive, from this article is this. There's some comments here, for example, and it says, not that this has assuaged, is that how you pronounce it?
Assuaged.
Assuaged, yeah, the growing concerns that we're seeing these extreme moves in US rates should be much more unsettling to the investor community than it has been, argues Peters. Is the treasury market functioning? And he says, absolutely. It's not like 2020, but it's still very fragile. So I thought that was interesting. It's still very fragile. This is from a former New York Fed head. He's got his head in the sand. I'm afraid, Clive, but we'll look at what he says. People are always looking for the next financial crisis, observes Bill Dudley, the former head of New York Fed. He argues Treasury yields primarily climbed higher because the Trump administration's haphazard approach meant investors had to price a wider range of outcomes into the market. There doesn't seem to be much evidence of serious dysfunction in the Treasury market. So this is a guy who, in my opinion, has his head in the sand. And this is, well, here, Clive, it says, in a world where people can't put on those trades, treasury yields would be much higher and US taxpayers would pay far more to borrow money. So, what this is saying, if it wasn't for highly leveraged, speculative hedge funds, and they're not hedged, they call themselves hedge funds, but when they hedge the futures and the cash and the basis trades or the swaps, they're also heavily involved in swaps between fixed income and floating rate, and they use treasuries. But when there's a disruption in one of the markets, it blows their whole trade apart. And to think that U.S. taxpayer is dependent on these hedge funds is I think it's concerning. And that's why we're seeing gold do really well this year and treasuries are still down. So I think their safe haven status is almost shot. But it says here, even some of the hedge fund managers that engage in these highly leveraged relative value trades acknowledge that without stricter regulatory guardrails, the possibility of more violent episodes for Treasury turbulence is high. For sure, it makes it more unstable, 100%. But the issue is the Treasury market is unstable. Says one, it's unstable because there's a lot of supply of U.S. government debt. So there you go, Clive. That's the underlying problem is all the debt, and this person here admits it. So I want your opinion now on this situation, and the fact that the supposedly most important market for financial assets on the planet is being kept alive by a casino, really, in my opinion.
Well, earlier in the article, you said someone wrote that there's no signs of dysfunction in the Treasury market. And yeah, that's true until there is. And when there is, it will happen very, very fast. We mustn't forget, first of all, we've got the debt ceiling in place at the moment, which means that since the 1st of January, the US government has had no new issuance of debt securities. No treasuries have been, obviously they've rolled over their existing maturities, but the way they're paying the bills at the moment is they're running down their cash balances. Those cash balances will run out sometime in August, and along with the emergency measures that they've got in place. So by August, they'll probably raise the debt ceiling again, and at that time they'll need to refill the coffers, probably with, according to the CBO's estimates, $800 billion. So there'll be quite a rush to sell treasuries, extra treasuries or new treasuries in probably July or August or early September, depending on when they raise the debt ceiling. So there's no rush of selling of debt at the moment by the government, because there can't be. That would be illegal. But that of course might be the moment when we have a crisis. Talking about the leverage in hedge funds, the way hedge funds work is they make a bet. I mean, I don't know why they call themselves hedge funds, because really most of them are leveraged funds, meaning they have a view, let's say a macro view, it could be, for example, or it could be a long short view, long being they think certain things will go up, and short meaning certain things will go down. And they then make a very large leveraged bet using other people's money on what their view. And sometimes they get it right, sometimes they get it wrong, but they have to make a leverage bet, because if they didn't make a leverage bet, if they were just what's called long only or short only, they'd be making normalized returns minus the hedge fund's outrageous fees. Now, those who've dealt with hedge funds know that hedge funds typically charge a whopping fee, way higher than mutual funds or unit trusts or ETFs. I mean, they're quite often the fees are something like 2% of the assets under management, plus sometimes a 20 or 25% extra fee on the profit they make. So to make these huge fees for themselves, they have to leverage up and make a massive, or try and make much higher returns than the market. Otherwise, it'd be pointless investing in a hedge fund. But of course, that doesn't always work. And when it doesn't work, things go wrong. But to make these bets, they have to stump up security. And the security they stump up with other people's money, of course, the investor money, are treasury bonds or treasury notes or treasury bills. So they buy all these, and typically they buy treasury bonds because they got the highest yield. They'll buy all these treasury bonds, deposit them with whoever they're borrowing the money from, typically a bank, and make their bet in a leveraged way, hoping that it works out. But of course, if it goes wrong, there's going to be a margin call, and they will lose the value of those treasury bonds as the person who's holding them, the bank which is holding them as security, starts to sell them into the market. So we haven't had yet any event, but when prices of something move very rapidly, there will always be somebody at the wrong end of it, and that quite probably will be, or quite probably will include some hedge funds, because there'll be as many hedge funds going long something as there are hedge funds going short something. So in a way, it balances out. But when something goes wrong, half of them will be wrong big time.
Yeah. Clive, the other thing they talk about is the liquidity, which means how easy you can buy and sell. And it's getting really in April when you had the fluctuations. I was reading here this article, and instead of having hundreds of millions of dollars, like let's say three prices, below the bid and three prices above the offer, you only had like 30 million, which is really a bad situation because you're supposed to, as a big institution, pension fund or foreign government, to call your broker or your treasury dealer and say, where are you for 200 million 2-year notes or 5-year notes? Because I've worked in this market and I know it. And if there's no bid or offer for these securities, they lose their safe haven status. And here, this chart, Clive, hedge funds have continued to build large derivatives positions in treasuries by short futures contracts. So, I mean, that's the market I also worked in the futures market. But look how huge, it. Look how leveraged they were prior to the COVID crisis, and then they unwound everything. But now it's even worse. And the other thing I want to show you, Clive, and the viewers, is that yeah, that national debt is running, but if you go on the time machine, let's say when I was working in the markets, let's say as far back as 2008, that national debt was only 10 trillion. Now it's almost 40 trillion. So there's, like that guy said, the problem is all the debt. And that's why I think what you were talking about earlier about the deficit and the CBO is really serious. And I think it's one of the reasons why you should hold on to your gold and silver as well, because they ultimately will be the safe havens, not treasuries.
The Congressional Budget Office has got a track record of consistently under estimating the actual level of deficits and underestimating the actual level of debt, both as an absolute number and as a percentage of GDP. So even though we're seeing these forecasts, which are pretty horrendous as forecast, the actual numbers are likely to turn out worse, as has almost always been the case.
Yeah, yeah, yeah. I know that's right. What else? Yeah,
Well, just talking of the, how the hedge funds, they're not the geniuses they say they are, always. If we go back to 1998, Mario, I'm sure you will remember, maybe
yeah.
some of your listeners weren't around
John Merriweather and LTCM.
yes, and Merton and the guy, the
Black
Nobel
Scholes
Peace,
model.
yeah, the Nobel Peace, not Nobel Peace, Nobel Economics, was it? I think. Oh,
Yeah,
anyway,
economic, that Black
prize
Scholes
winner.
model. Yeah.
Yeah, Mr. Black, or Black and Scholes, and this other guy called Merton. They ran this hedge fund called Long Term Capital Management, one of the largest in the world, making tons of money because they'd found the perfect formula, guaranteed to make a ton of money. And then in 1998, it blew up. And
Yeah,
it
it
blew
blew
up
up because of the Italian debt market, wasn't it?
Russian, I think it was.
Russian, yeah, but they had a big bet on the Italian bonds. I think they were doing the basis trades, but you're right, Russia defaulted. And in this article in the FT, Clive, they talk about John Merriweather because the basis trade was like invented by this guy from a small private bank, investment bank in 1979. And it was at the time the futures were cheaper than the cash, so he was buying loads of futures and selling the cash. And if he waited into the maturity of the futures, he would make a little profit, guaranteed. But the problem with these trades is that in the meantime, if the market moves around, you need a lot of margin. Like you said, your banker will call, we need margin. And these people couldn't handle it. So they sold the trade to Solomon Brothers and John Merriweather. So John Merriweather made millions from these basis trades. And eventually he went bust with this with his, the New York Fed. Ultimately, Clive, the taxpayer is going to be on the hook again for
Yep.
speculators who earn billions.
Well, the loss made by LTCM was so large that the Fed had no choice but to bail it out to save the banks, the banking system from failing due to that particular crisis. Obviously, it didn't turn into the banking crisis we had in 2008 because the Fed stepped in and saved LTCM to stop the banks from failing. So that was a lucky escape. So we didn't have any particular reaction to that, but we would have done had they not been fast enough.
And Clive, ultimately, these hedge funds, they're all linked to the banks because they're usually like ex-traders from bankers who want to go at it alone, and they get all the funding from the banks. And I think, I don't know when it was, maybe you remember this, but the FDIC, who's supposed to protect depositors' accounts, the public's account, they're now would be on the hook for protecting the banks from losses from derivatives. So I think it's a can of worms. And do you remember 2 or 3 weeks ago that Jamie Dimon had a private conference in Washington, D.C.? He invited Scott Bessent private meeting between Wall Street and the government because I think it was a time of this crisis where, and they told Bessent, if you guys don't back down with these tariffs or whatever, the whole Treasury market is going to collapse. I think that's what was happening. This was like, and that's why they backed down.
Yeah. Shall we talk about that article in the FT this morning about China and their divesting of US
Yeah,
treasuries in favor of gold? And
China,
you,
China.
China, yes. While you're bringing that up, Mary, I'll just show your viewers a coin I bought on Wednesday.
Oh,
It's
I'll let you
solid
show it.
gold.
I'll let you show it first.
It's the from the UK. It's what's called. It's part of the Queen's Beasts. That's the Queen of England, former deceased. And the on the back they have. There's I think about 12 of these coins. This one is called the Griffin of Edward III, and it's a 2017 coin.
Yeah, I've got some of those. And the story behind mine is that I bought last year some of the 1 ounce coins that have they look like a sovereign, but they put the St. George's slain the dragon on a big 1 ounce coin, and it's really nice. And I bought some of those. And then Oliver from Gold Investments called me and said, I can't get those anymore, and I know you have some. Would you exchange them for these beasts? And I said, fine, because his client really wanted those coins, and I didn't really care too much. I still have one of those, but yeah, they're really nice. And in the UK, for the UK viewers, if you have coins of the realm, i.e., minted by the Royal Mint, They don't incur any capital gains tax. So there you go.
Yeah, so this is a £100 coin. I didn't pay £100, by the way. I paid 2,930 Swiss francs, which for your UK viewers is about £2,669, and for your US viewers is about $3,500.
Yeah.
So I'm paying a little bit of a premium over the
Yeah.
gold price for the rarity. But you know, when I think about it, the coins of the same collection, which I have bought in the past, I think the previous one I paid maybe 2,500 Swiss francs. This was 2,900, and the one before that something like 1,800. So it doesn't really matter what the price is today. The important thing is it's an ounce of gold, and it will always be an ounce of gold. And I know an ounce of gold is not going to be worth a lot less. It's probably worth an awful lot more years from now.
I agree. When I look back, and probably you as well, for example, when I started buying gold, it was at 220 pounds an ounce. If I and I thought that it would keep going up, but I would have bought a lot more, but knowing where we're now, but you can't really look back. But the thing is, it's hard to buy gold unless you're running a good economy. And what is a good economy? Well, it's your household. Running a good household, i.e., economy, Clive, I'm sure you know, comes from the Greek. Running your household, you have to have more income than outgoing. And that's very difficult these days. But anyway, here's the article you told me about. I hadn't seen it. It's only come out 4 hours ago. So it's 9 o'clock a.m. London time here. So how China is quietly diversifying from U.S. Treasuries as investors become increasingly anxious about U.S. government bonds. There you go. Chinese officials are looking for ways to reduce their exposure. So have you read this, Clive?
Yeah, yeah. So the interesting bit is if you scroll down to the part which says China ranks sixth in gold holdings, yet gold comprises only 6% of its reserves. Now, we're looking at the chart here that you're showing, Mario, and it shows the reserves as gold as a percentage of reserves in other countries, like Germany is 75% of reserves, Italy 72% of reserves, France 73% of reserves, Russia 33% of reserves, China only 6% of reserves. Switzerland 10%, India 12%, Turkey 37%, Netherlands 66%. So China is way behind the rest of the world in terms of amount of gold it's got in its reserves, but we are seeing that it is consistently, month after month, buying gold. And if you read a little bit, I think we should read those three paragraphs at the bottom because it says, in words of one syllable, China is slowly but surely increasing its exposure to
Yeah.
gold and other things
Is
at
it
the
these
expense of treasuries.
paragraphs? These paragraphs here?
That's right.
Yeah.
If you
Can I
read
just make a comment as well? There are a lot of people who feel that China has a lot more gold than these official numbers, which would be, some people say that the Chinese people themselves have 25,000 tons, and that the Chinese government, that apparently the PLA, People's Liberation Army, they've been buying gold since China became, you know, People's Republic of China. Yeah, in 1949, and they say that the government probably has 25,000, but they would probably call us conspiracy theorists, Clive, until China comes out and says, actually, we got a lot more. But anyway, I'll read this, or do you want to read it? Yeah.
shall I read it? It
Yeah.
says, I am deeply worried that the ongoing US China trade dispute could spill over to China's foreign assets, said Yu Yongding, a former member of the Monetary Policy Committee at the People's Bank of China and a senior advisor to the government at a conference in early April this year. He cited media speculation about a Mar-a-Lago Accord along the lines of the 1985 Plaza Accord, based on an essay by Stephen Miran, now chair of Trump's Council of Economic Advisors. The aim of such a plan would be to weaken the dollar and persuade other governments to swap their treasury holdings for 100-year zero coupon bonds in return for more lenient trade tariffs. And then it goes on to say few in financial markets believe this plan will be implemented. But for you, it is still a concern. Such a swap would constitute a default, he argued. That poses a huge threat to China. Don't forget he's an advisor of the Chinese government on their
Yeah.
monetary policy. It would pose a huge threat to China, and we may end up paying a steep price. So basically, what they're saying is, earlier in the article, they're saying that China is, they're not rushing to get rid of their treasuries, but very, very slowly and surely and methodically, they are reducing their treasury exposure for other short-term assets, and specifically mentioned here, short-term assets and gold, which is only 6%.
Yeah.
By the way, a couple of years ago, it was only 3%. So the gold exposure is increasing little by little every month. And I'm waiting to see in a couple of days what the April purchases were like, but I've no doubt at all they were buying again in April. And of course, almost every month they're buying at record prices and they don't care. I mean, why should a central bank care if they pay a record price? Because all
Oh,
they're doing is
yeah.
swapping worthless paper for something tangible.
I know they don't care about the price, the sovereign buyers, and I think one of the reasons they're going slowly with treasuries is because they have so much of it. I think about 750 billion. That if they sped up the sales, it would crash the market, and they'd be holding stuff that isn't worth as much, or the U.S. could freeze because the U.S. could say this is a hostile act. You're selling our treasuries. We will freeze your account.
Yeah, I
So
mean, I can see exactly how that's being thought of. They must be terrified about the treasuries they hold, but they also are aware they can't do anything sudden or disruptive, even though America's doing something disruptive with the tariffs. China says we can't do this because if we do something disruptive, they're going to mess with us, and we might find we suddenly can't do anything at all because they've frozen our ability to do it. So I think it's like anybody. Imagine it's you, Mario, and you've got a safe with $10 million in it, and you'd like to put this in a bank. You know very well that if you try to put it in a bank, they're going to freeze your account because it's cash. That huge amount going to the bank, so you can't do it. So what are you going to do? You're going to little by little slip a couple of £100 or a couple of £1,000 every month into different bank accounts. And I think that's what the Chinese are doing. They've got this massive pile of treasury bonds,
or
but they
Clive,
can't do.
or I could buy some gold coins every month too with it.
Little by little, and that's
Yeah,
what China is
yeah.
doing.
Or
So
some nice.
that I think is the problem. They've got too much of these treasuries, and
Yeah.
they can't do anything with it in a hurry, or it will create a negative reaction, not only from the market but also probably from the treasury, who will see it as a hostile act.
And Clive, I wanted to ask you actually because the stock markets they didn't start the year very well, and people say that usually the first 2 months, if it's up, it means it's going to be a good year. If it's down, it's going to be a bad year. But lately, since Trump and Besant kind of backed down, and I think they did back down at the urging of Wall Street, it seems like things have calmed down. Do you think things are out of the woods now and everything is great, or do you think this is the lull before another storm for the financial markets?
Well, I think we've got several pulls here. First of all, markets are down quite a bit from their peaks and showing no signs of making a new all-time high. We some time ago, I think we were on a show with what was the name, Andre from Brazil, and
Yeah.
we said that the Nasdaq was going to go below 20,000. Well, it's still below 20. It's now below 20,000, although it's battling to try and get back above 20,000 again. But we've had from a couple of U.S. companies like Microsoft and not Facebook, Meta, quite good results last night, but they are net beneficiaries of artificial intelligence, and we've had some negative results coming out of Apple and Amazon. Apple have said that they're going to have, I think, in this quarter, from the tariff effect, an impact of $900 billion on their bottom line. That's on their profit forecast, $900 billion thanks to the tariffs this quarter. Well, it's going to be a lot higher than that in subsequent quarters if this 90-day freeze on Chinese tariffs comes into effect, which is in another 60 odd days, I think. And Amazon has given out a warning that they're facing tougher business conditions ahead. Again, there are a lot of what gets sold via Amazon comes from China originally. We're starting to see companies. We're in the reporting season. We're starting to see more and more companies come out with their results, and a lot of them will be saying what the impact of tariffs is going to be, and it's not going to be good. There
Yeah.
won't be any companies saying these tariffs are wonderful for us, where our share price is going to go to the moon, our earnings going to the moon. The only possibility that we'll get from these in reporting season is it's bad for us or it has no impact.
Yeah.
So I think we probably will go lower on the stock market. But there's an awful lot of people out there with cash on the sidelines, and they're looking to buy every dip. And I think there's a lot of people saying, if it dips, I'm buying. I mean, I've had many people write to me in the last 30 days alone saying, I'm holding cash and I think the market's going down and I'm going to buy the dip. So in a way, that's quite supportive of the market at the moment. But you never know. If we get some bad news, the market could plunge rapidly. But at the moment, it's holding up well. But I think that there is a trend of putting money into gold at the moment. It's gold is holding up very well as well, and I think that got along with the central bank buying. I think the private buying of gold is going to start to increase a little bit as the stock market fails to make all-time highs.
Yeah, and the other thing that markets hate is uncertainty. And the uncertainty has been kind of neutralized a little bit in the last few weeks vis-a-vis all the trade situation. But I can't see it staying stable for the medium to long term because I think the Trump administration doesn't matter what you think about it. They're going to continue to disrupt things, and it's going to be really hard. I think I was reading an article about how maybe 20, 25 years ago, the reason companies went to China was for the cheap labor. And now, though, even though you do still have cheap labor, China's built a whole infrastructure of supply chain for all kinds of goods, not just in China, but in Southeast Asia. And to think that you could move iPhone production to the US like in a few months, it's like really not that easy. So yeah, I think like you, Clive, I think there will be continued uncertainty in the stock market, and yeah, and I think the correction in gold is probably healthy, I think, because it really ran up, very quickly to 3,500. But and I noticed that the miners, Clive, even though gold corrected quite sharply, they haven't really corrected as much as they normally would.
Yep, I think people when they sell their stocks, they look around for something to buy, and you know, the view across the board is now that gold is more of a stable asset, if not a growing asset, and you want to buy into companies which are not negatively affected by the tariffs, and obviously the mining sector is not negatively affected by the tariffs. Those who are negatively affected are those with a supply chain from somewhere overseas.
Great. Clive, I'm going to wish you a really great weekend. And are you up for the live stream on Sunday?
Um, yes, I think so, Mario. I'll confirm that to
I
you.
put you on the. It's all right. It doesn't matter anyway.
I think so. Yes.
I'll be there, but if you can make it, Clive, that would be great. And any final words for the viewers?
Well, stay diversified. If you want to tune into my channel, please do so. I'm very happy to answer any questions I receive via LinkedIn. I would just say I did on one occasion get more than 200 questions in a single day, and that was quite tedious to answer. I don't mind answering the questions, but please, if you want to write to me, try and put a bit of effort into it, in terms of telling me about yourself or what you think. Writing to me and just saying, give me the name of three gold mining stocks or something like that. No, just
Yeah.
tell me where you're coming from at least, so I can give you a meaningful answer.
Great. Thank you, Clive. And yes, thank you, everyone. And I'll talk to you guys later. Bye.